Good afternoon, everyone. It's a pleasure to be with you this afternoon. My name is Julien Bourgeois. I'm a partner in the Washington, D.C. office of Dechert. Usually, David Harris and I are present with you in Brussels for this conference. We're glad to be with you again this year, although this time we're live by a Zoom in the United States for us and wherever you are in Europe for you. We hope that everybody is healthy and in good spirits in this environment. This has been a strange year for all of us, and it is a strange time, interesting time for us in the United States and the big American democracy now. Today, we're going to discuss with you what's happening for asset managers on the regulatory front in the United States. To do so, we'll have Andrew Oringer. Andrew is a colleague of mine in our New York office, and he specializes on pension assets, pension investments, and a US law that we call ERISA that applies to retirement funds, private retirement funds. He'll explain that to you. And Andrew will talk about ESG and pensions in the United States, and I think you'll be quite interested in hearing what he has to say, given the contrast between where the United States is versus Europe. Then we'll go to Craig Falls. Craig is a partner of mine in Washington, D.C. He's actually sitting right next door behind the wall behind me in his office. Craig is an antitrust attorney. He works on competition law issues. He's been doing a lot of work over the past year and a half for asset managers in the United States, but also outside the United States. And he'll tell you why. It's a debate, it's a development that also has importance in Europe. You're seeing parallel developments in Europe, but Craig will explain that to you. Then I think you probably, if you've attended this conference in the past, you'll probably recognize David Harris. David Harris is a partner of mine, also in Washington, D.C. He's not in the office. You can tell by his background. He's at home, but he's doing well. And David will be happy to talk about regulatory development closer to the asset management space, classic asset management space, and he'll focus with me and Drew and Craig on try to outline what we can expect in the next 4 years in the United States, assuming that the Biden camp takes on the White House, which we assume will be the case despite all the drama on TV. So without further ado, I'm gonna leave the floor to Drew for the next 10-15 minutes to talk to you about pension assets with a note of caution. To understand ESG in the United States, you need to understand that ESG is not something that is defined from a regulatory or legal standpoint. In the United States, the definition of ESG is essentially left to the asset manager to determine. And the concept that applies here is in the broader sense, full and fair disclosure and client consent. You could understand ESG regulation of asset managers outside ERISA in the United States to be say what you do what you say, and get your clients to consent to what you do. So that's the basic background, which of course is quite different from what you're accustomed to in Europe. But Drew, go ahead.
Okay, thank you so much, Julian, and thanks to everybody for this opportunity to speak to you all. I just want to expand or agree with what Julian just said on the notice and consent rules outside of ERISA. He pointed out that was a comment that did not necessarily relate to ERISA. ERISA is not a notice and consent statute generally.
And we can go to slide 5. I'm sorry, Drew. For the audience.
Yeah, that we are on slide 5. There we go. Okay, so ERISA is not a notice and consent statute. It is a statute that provides for rules that have to be complied with, generally speaking. So that's very good opening contrast there. Before I get started, I also want to mention that we have some pretty comprehensive materials that have been made available in connection with the session. So for anybody who's interested in these issues on the ERISA side, you may want to look at those. All right, so let's get started. What is ERISA? As Julian said, ERISA is the U.S. law that comprehensively governs U.S. corporate and other private employee benefit plans, including retirement plans, pension plans, and individual retirement accounts. Really, what you're talking about predominantly is pension and 401k plans and IRAs, 401k being the statutory provision that allows employees to defer their salary into retirement plans. Now, as many of you know, maybe even most of you, there's a whole lot of money in pension plans governed by ERISA. Back in the day, ERISA money was referred to as the biggest lump of money in the world by one white paper. You can think of pension and other employee benefit plans in this regard as being a type of investment fund. It's just money that accumulates really only for two things: to pay benefits and to be invested. And ERISA plans are amongst the most major players in the global capital markets. So the way ERISA approaches ESG is not only critical in the United States, but it really can have significant global reverberations. Now, when it comes to ERISA, I want to begin with the overall conceptual point, and this is really important, that as a general matter, ERISA is single-mindedly driven to worrying about whether retirement assets will be there for people at retirement. The focus on economic returns over all other considerations may actually be greater than what you're used to seeing elsewhere in the world. And so when it comes to ancillary non-investment goals, the idea is that the focus should be only on whether retirees who are no longer employed will be able to rely on the assets that have been set aside for their retirement. That's what ERISA looks at. The idea really is that retirees are interested in whether their pensions are there for them. They are not interested in saving the world with their retirement assets. That's the concept. Now, under ERISA, the central fiduciary rule is known as the prudence rule. It's essentially a negligence standard with some modifications. And then the prudence requirement works together with a duty of loyalty. And as one court famously put it, the duty of loyalty requires the fiduciary to look with an eye single to the interests of plan participants and beneficiaries, and the reference there is to financial and economic interests. Now, under ERISA's construct, and this is also important, the fiduciary is not specifically told what to invest in, but rather is asked to proceed without being negligent. Okay, so what you get under ERISA is deference to an unconflicted fiduciary who has taken into account the relevant considerations in an educated manner. A lot of deference under ERISA. ERISA is considered really positive in that regard. This sort of procedural prudence, if you will. The problem is with ESG that there can be a question as to whether the fiduciary is worrying about something other than the economic best interest of plan participants. It's really a potential loyalty question, if you will. Is the person who's investing worrying about social goals, or are they worrying about the financial and economic interests of plan participants and beneficiaries? Okay, but ERISA's general focus on economics turns out only to be the beginning of ERISA's ESG story. Ever since the first time, decades ago, that the US Department of Labor addressed social investing, the principle was established that non-economic factors may indeed be taken into account sometimes. The concept was that for the concept was that investing for non-economic reasons does not have to be completely eliminated. The problem is that you can't look at ESG at the expense of economics. Now, within this basic tack, while this basic tack has run through the regulatory guidance consistently for really about 45 years, what is happening is that the tone and the emphasis of the authority has changed with the politics of the day. So you'll see Democratic administrations trying not to overtly discourage the pursuit of social goals when investing pension assets. You'll see them trying to let that door be open ajar a bit. And then you'll see Republican administrations come back and indeed try to discourage the use of social factors. And there's this ebb and flow. And with the current administration, the pendulum has, not surprisingly, swung towards relatively greater regulatory hostility towards the consideration of ESG factors when it comes to investment by ERISA plans. But the basic principles remain in place throughout the pendulum swing, throughout the swinging of the pendulum, and that is that it's really investment first. And you can move the slide now to slide 6. So what we have here is the Department of Labor's final regulation on non-pecuniary investment goals. For the first time, we have an actual ERISA regulation that affects ESG. And what this did is it gave the Department of Labor, the DOL, more flexibility to write the rules really the way they wanted. It also actually locks in the current DOL's thinking so that future interpretations, what's called sub-regulatory guidance, can't easily reverse what they've done here because they've really changed the rules. And I'll make one brief reference here. Okay, so these rules will go final, and they'll go final either right before or presumably right at the beginning of January. And so that presumably they will be locked in before there's any change of administrations. People have wondered whether or not subsequent administrations are going to try to now change these rules for reasons that we're going to see, which is that the Department of Labor softened its stance from the initial proposals. It's not 100% clear to me that a new administration will necessarily have it high on their list to attack what's been done here. They might. It's just not as clear as that would have been as compared with the proposed rules. Okay. Now, over the course of finalization, getting back to what I just said about softening, the DOL did remove all specific references to ESG in the final version of the rule, which is a very significant softening from what the initial DOL position had been in the proposal. But notwithstanding that, and regardless, the regulation will undoubtedly make it more challenging to pursue ESG type goals in an ERISA plan. In fact, to me, and I'll summarize with this, really, this is a big point. Perhaps the biggest practical impact on the market has been to move people away from trying to argue that ESG won't hurt you investment-wise, and really towards trying to make the case that an integrated ESG strategy will actually help investment returns. That's where I think the market has been pushed, showing that ESG is actually investment positive. Now, the DOL remains skeptical that ESG presently can be shown to be investment positive, but the final regulation would appear to allow you to make that case. And you can move to the next slide, please. So how will all this play out as a practical matter? Well, first, it may be harder for ERISA plans to choose strategies that pursue ESG at the expense of returns. Fund disclosures that worry about reduced returns could raise real issues. But the regulation does leave open a path for fiduciaries to choose strategies that do use ESG as one of several factors where it can be shown that there's an affirmatively positive effect on returns. On the other hand, it may be more challenging for many ESG-centric and ESG-themed investments to get through the ERISA gauntlet. While the regulation potentially permits ESG to be used as a tiebreaker when there's two equivalent investments, the DOL considers this, right now at least, to be essentially only a theoretical path. And my final point on the substance of the final regulation here is that it will be very hard to use ESG funds as default investments for when individual participants in individual account plans want to invest in funds. Now that's a big, the default investment, what these plans do is they set up default investments that if there is no election, that's where the money goes. And it's going to be very hard to get ESG funds into those under the new regs. That is a big deal because in a lot of cases with people being creatures of inertia, the money really just goes into the defaults and just stays there. And now, all of this will present real challenges, as Julian foreshadowed, for global managers who may now feel themselves caught between a bit of a rock and a hard place of trying to satisfy EU and other concerns while still being able to market to ERISA plans. And then move to the next slide, and we'll wrap up this portion of the presentation. I just want to spend a minute or two on the Department of Labor's proposed proxy regulation, which is also relevant to the ESG question. Here, what the DOL has done is essentially discourage voting on non-economic matters very significantly. In fact, the DOL went really beyond ESG here and proposed to discourage voting on a whole host of government and on a whole host of governance and other matters. The proposed regulation would sweep proxy advisory forms into the mix, and that's actually a big deal too, considering how big those firms have gotten. Here again, it would be an actual regulation, not mere sub-regulatory guidance that's been proposed, but we haven't seen the regulation finalized yet. And given the election, the ultimate fate of this particular piece of the rulemaking is presently unclear, unlike the main prudence loyalty regulation, which has moved to finalization. Now, I think that's all I've got. Julian and Craig, I'm going to move this now back to you.
Thank you, Drew. your presentation obviously highlights that there is currently in the US pension space a conflict of law, if you will, between Europe, who's moving quickly towards sustainability and sustainable investments and investment strategies, and the US legal framework for pension assets, which, as you can tell, doesn't really accommodate or openly accommodate ESG strategies or sustainable investment strategies in the United States. So obviously, Biden has not hidden that he meant to quickly rejoin the Paris Agreement and wants to pursue sort of a greener agenda than the Trump administration. So it will be quite interesting to follow what's happening on this front.
Very well put.
And there's so much money in the United States coming from pension assets, retirees, and the like that are subject to those standards that Drew mentioned. And for European asset managers who have subsidiaries in the United States or simply offer their products in the United States, it's an issue because you're going to be forced to push the European agenda of sustainability. You're going to have much more disclosure very soon about sustainable strategies. And those disclosures, that push is going to come in direct conflict from a commercial standpoint with what planned gatekeepers, if you will, are looking for retirement savings in the United States. So thank you, Drew. Now let's go to Craig. And Craig, it's an interesting topic. You've been spending several months to explain those developments to us and why it's coming out the antitrust side of the field, but it impacts asset managers. So go ahead.
Thanks, Julian. So as Julian mentioned, I'm an antitrust competition lawyer, not a funds lawyer. And if you're surprised to see me here on the panel, well, that's understandable because antitrust law has typically not applied much scrutiny to the asset management industry. But recently, over the last decade or so, with the rise of index-based investing and sector-based investing, there's been a concern expressed about whether companies that compete with each other have the same investors and whether those common owners of the companies are exerting influence in a way that is causing companies to compete less aggressively, and whether this may in fact be a huge blind spot that antitrust has in the United States and in Europe as well, and whether there needs to be some dramatic changes in regulation or in enforcement to limit the extent to which there is common ownership. And the debate has been going on for about 4 years. It was very active about 2 years ago. And although some of the discussion has now, or the focus has shifted to big tech, we're not hearing that much about common ownership in the United States in the last 6 months. There's nonetheless real impact on policy. We're seeing proposals from US antitrust enforcers that would dramatically increase scrutiny and burdens on the asset management industry, despite the fact that the debate is still ongoing. And so what I was hoping to do in this presentation today is give you a little bit of overview of what the debate is, well, what the two sides of the debate are, what the enforcers currently think about the debate, and how that might change in a Biden administration. And then finally discuss the ways in which it's already starting to impact burdens and scrutiny of asset managers. So if I get the next slide, please. So common ownership is in effect a situation in which there are minority interests, non-controlling interests in more than one competitor in an industry. And antitrust has always had a concern about minority investments when the entity that has the minority investment is itself a competitor. So for example, if one airline were to take even a 5% interest in one of its competing airlines, rival airlines, that would of course always have been a concern. What hasn't been a concern traditionally is when there's some institutional investor that takes a 5% interest in two different airlines. And so this concern is rather new, and there's not a lot of precedent for it. But academia, a lot of academics have been interested in this topic and have been publishing a number of different economic studies that purport to find a correlation between the amount of common ownership in an industry and effects like higher prices or reduction in output. Some of the main papers have been done on the banking and the airline industries. And some of the criticism of that is these are two highly regulated industries. And so maybe these papers don't really reflect the effect of common ownership more broadly in the economy. And there's a lot of other criticism that I'll get into about these studies. But those initial papers purported to find a correlation between the amount of common ownership and price increases, and predicted that the extent of common ownership will be correlated with higher prices and lower output. After those papers came out, there have been a number of other studies more recently that have tried to tie common ownership to certain types of observations, such as the extent of common ownership is correlated with the executive compensation type structures that prefer sector-wide performance over individual firm performance. One paper seems to find that. Another paper seems to find that, or purports to find that, when a company is included in an index, it doesn't only increase the stock price of that company included in the index, which is to be expected, but it actually increases the stock price of all other firms in the same industry. And the assumption of the paper is that that makes no sense unless there's some sort of lessening of competition expected as a result of inclusion in the index. So most of the evidence so far of whether common ownership exists is really based on these academic papers. There's not a whole lot of enforcement actions or anything else to prove that there's actually any impact of asset management on competition. At the same time, there's been some statements by asset managers about how they can, how much influence they have over their investments that has been somewhat contributing to the scrutiny. And so the asset managers are not really doing themselves much of a favor by speaking about how they can influence their investments. And so far, most of those statements have been done in the sense of influencing these companies for good. For example, there were statements about how asset managers can maybe help companies work together to solve the COVID pandemic. But of course, when you have a power to help companies cooperate for good purposes, then the assumption is that you also have the power to help companies cooperate for anti-competitive purposes. So let's go to the next slide if we can. All right, so one of the big problems with the common ownership theory is explaining exactly how common ownership impacts competition. And there's been a variety of different theories proposed, and some of them are mutually exclusive. One is that the asset managers are, when they meet with management of the issuers, they are somehow pushing those issuer management to compete less aggressively or to solve industry-wide problems. Say, for example, asset managers get in a meeting and say, you have to, everyone in the industry needs to reduce capacity because demand is down. I know if you reduce capacity, your rivals will do the same. That sort of conversation would be a problem under antitrust law. But the industry will tell you that's not what happens in these meetings, and that there's a strong interest in not obtaining material non-public information, and so that's not what happens at all in these management meetings. So the other theory then is that the asset managers are instead using voting against management proposals, or that they are voting on executive compensation that somehow punishes management if the management is competing too aggressively and working against the portfolio returns, the sector-wide returns of the managers. And that's also not really there's no real evidence of that, but that's one theory proposed. On the other hand, there are passive theories, and the idea is that asset managers don't need to do anything. If asset managers simply hold a broad portfolio in a sector, then the managers will know that they should start operating the issuer management will start operating their companies to maximize portfolio returns for their largest investors, as opposed to single firm returns. And then that would naturally just cause management to change how they compete, just knowing where their bread is buttered by their largest investors. And then finally, on the opposite side of the spectrum is just the idea that institutional investors are just too passive. They don't engage enough in corporate governance, and that is causing management to relax its competitive efforts. So you can see that the theories are all over the map on this. Let's go to the next slide, please. All right, so what I want to address now is whether, assuming even if these theories are proved to be true, is this actually an antitrust violation? Does this actually violate the antitrust and competition law? Well, certainly the easy answer is if asset managers are encouraging companies to compete less aggressively and in management meetings and providing assurances that their rivals will do the same, well, that's facilitating cartel activity. That's an easy one. That has always been unlawful if that is happening. Would an asset manager violate the antitrust laws by simply holding the assets of competing companies? That, some have suggested that could be one type of merger or acquisition that the U.S. antitrust enforcers could try to block. It's very doubtful that that sort of theory would actually fly in the courts. And so what's been proposed has been sort of this acknowledgement that antitrust law may not reach the common ownership issue at all. And instead, we need some regulation. And we've seen proposals that have been taken seriously, although they haven't had much traction, in which you would only be able, an asset manager, not just at the fund level, but at the advisor level, would only be able to hold one company in a given industry, or if it holds more than one company in a given industry, it can have no more than 1% ownership of that company when aggregated across the entire asset management complex. Of course, this would be devastating for returns on investment, for diversification. It would be very bad for capital formation generally. And so there's been a lot of pushback against that proposal. And that, by the way, that proposal is coming from academia and maybe some former enforcers who are now in academia. It's not coming from the enforcers themselves. So go to the next slide, please. All right, so the industry, of course, has responded very aggressively to this theory. They push back. There's a lot of actual problems with the academic research purporting to even find a problem in the first place, based on methodology, based on data, based on other things. But more importantly, the industry has pushed back and said there's really no reason why asset managers would want to interfere with competition. That asset managers, if asset managers increase the prices of airlines, that might help them a little bit, but it really doesn't convert much into new revenue for the asset manager. And by the way, it could have spillover effects on other investments, such as hospitality industries, other areas of the economy in which they also hold investments. And so the strategy to actually interfere with competition is very difficult to pull off, and also unlikely to actually be profitable. So there's really no incentive to do it. And then on the other side of it, the idea that company management will just naturally start managing their companies to maximize portfolio returns as opposed to single firm returns is not borne out by the evidence. I've personally looked at strategic plans for thousands of companies in the course of merger reviews. I've never once seen a strategic plan that is based on maximizing investors' portfolio returns as opposed to doing what's best for that single company. I just don't think there's any evidence whatsoever of that theory. Let's go to next slide, please. All right, so the now just to discuss where the enforcers are. The U.S. enforcers have been pretty non-committal on the theory. You haven't seen it. Certainly haven't seen any enforcement actions brought by the U.S. enforcers based on this. In Europe, European enforcers have brought up the common ownership issue when they've looked at actual mergers between competing companies like Bayer Monsanto. They had a long discussion of common ownership in their merger decision, but it really didn't do any work. They just pointed to the existence of it, but they didn't really have any impact on the overall result. So the U.S. enforcers, European enforcers too, are generally not taking a position on it, but at the same time, they can't rule it out. I think you would see in a Biden administration more attempts to develop the research on it, to scrutinize common ownership a little bit more aggressively, to at least come to a position on whether it's a problem or not. And so where have we already seen this have an impact? First, the enforcers have announced that when they're looking at merger reviews between two companies that are competitors, they are looking at how those companies are communicating with their largest common owner investors. So if you're having written communications with the issuers in your portfolio, you should know that when those companies engage in a merger, those communications with the asset manager are going to be reviewed. And that is new. That has not really traditionally been the scope of merger reviews previously. But now enforcers are using the merger review process to see if there are active attempts by asset managers to reduce competition. Separately, the really big news is that just a few months ago in the US, the antitrust enforcers have announced a change to the system which requires companies to report and make a filing and observe a waiting period before they acquire a equity security, which is called the Hart-Scott-Rodino Act. Traditionally, asset managers do not have to make filings. They can just go ahead and make the purchase as soon as they want to make the purchase because of the way the rules work now. There are exemptions for institutional investors. They don't really have to make these filings. They don't have to observe the waiting period. And for the most part, it's not an issue. If these changes that are currently proposed, not final yet, but are proposed, go into effect as written, you're going to see that asset managers acquiring U.S. issuers are going to be having to make somewhere around 20 to 100 filings a year, which will create a lot of burden, a lot of expense, and more importantly, observing the waiting period before you can acquire the share is going to cause a lot of problems because you'd have to wait for the enforcers to decide not to investigate. And this would create all kinds of problems like execution problems on the acquisition, or problems tracking the index because you're waiting 30 days to have to acquire the new shares. And at the same time, it's going to subject more asset managers to scrutiny, where even these ordinary course transactions you're making for a rebalancing or because of ETF dynamics, you're going to have someone at the U.S. enforcers now looking at your acquisition and determining whether your aggregate position is too large across different companies that compete in the same industry. So all this is relatively new, and despite the debate being ongoing and the fact that U.S. enforcers have not taken a position on it, it's already having these large impacts and will result in more scrutiny and more burdens. So with that, I'll pause and see if there's any questions, or we can move on to the next topic.
Thank you, Craig. for questions, let's pause for a second before we jump to the next section and give the floor to David. Let's go back to ESG for a second, and then if we get an antitrust question, I'll pass it to you, Craig. Drew, how do you look at the integration of financially relevant ESG information in the investment process under ERISA?
Yeah, thank you for that. I think that the first thing to do there is to sort of set up a counterpoint, a contrast between sort of an integrated ESG approach and an ESG, a fund that's actually looking for ESG returns. A fund that's looking for ESG returns, that's a little bit in the crosshairs here. That puts you back in that notion of trying to show that you're not in any worse shape than you'd be in a fund that doesn't have that kind of a focus. And that's where you have the skepticism that the DOL really doesn't trust that there's ever true equivalence and views tiebreakers as more theoretical, at least the current DOL. When you have an integrated strategy where ESG is just another part of the equation, that's where I think the market is now pushing, or the rules have pushed the market to trying to validate that integrating an ESG strategy is investment positive, is favorable. The problem there is that the Department of Labor has indicated that at least under present generally accepted investment principles, the DOL questions whether or not ESG truly is helpful to investment returns. But I think that's where the rubber's going to hit the road. That's where people are going to go. And I would just make one last point before throwing it back to you, Julian, which is that where you have disclosure right in the disclosure materials that says that pursuing ESG type considerations may wind up adversely affecting investment returns. That's exactly the kind of thing that the new rules are sort of pushing you away from. And so I think there's going to be additional sort of consideration of whether or not it's possible to have these disclosures omit references to possible downside risk for investments for pursuing ESG, and much more to focus on the fact that ESG concerns are being pursued to increase returns. So hopefully that addresses your question, Julian, but I'm happy to continue to go forward with it.
I think it does, and it wasn't my question, it came from the audience. Thank you very much, Drew. Another question from the audience, still on ESG, and then we'll go to Craig before finally going to David. Was investor demand in the United States for ESG strategies. I'm a lawyer, so I don't keep very close track of data, I must admit, but I get a sense and I see it regularly. A few elements to that answer. I think first, it's very difficult to quantify accurately investor demand when it comes to ESG. We can quantify the number of US funds or funds offered in the United States that have ESG labels or that are classified by Morningstar, for example, as following investment strategies or having an ESG rating, and that's booming. Many of those funds are funds that have been in existence for a long time, but now, as a result of integration, for example, of ESG standard and strategy, now have Morningstar ESG rating. So new ESG focus fund are also exploding. The demand itself, I think for a long time, we used to say, look, there are some institutional investors in the United States that are focused on ESG investments, and then millennials are also interested, but they don't have that much money to invest yet. And the rest of the investing or retail investing public is a little bit skeptical of ESG or not yet focused on it. I think that's gradually changing and evolving. And I think it will probably evolve a whole lot with an administration that embraces more openly sustainable concepts and a green agenda, if you will. So,
yeah, and there is some anecdotal evidence that individual retirement participants are looking for ESG funds in their individual account retirement plans.
Craig, quick one for you. Under your HSR regime, is there a minimum threshold of dollar value or share numbers that is considered for investment? Could manager take a small position for example to deal with, the administrative friction, or what are your thoughts here? What is too big to fail, too big to play in the space? And I'm just quoting the question.
Yeah, sure. So let me try to address that in a couple of ways. First, there is a threshold just for every entity that wants to acquire an equity, voting security. That would be your cumulative position after the transaction is over 94 million. Now, the reason why funds tend to not have to file anything is because under the current rules, when you look at whether they have the 94 million, you're looking at it only on a single fund basis. You're not aggregating across all different entities that are advised by the same asset manager. That would change under these new rules. So immediately the size of your transaction, your size of your holdings is going to go up dramatically. But more importantly than the 94 million is that registered investment funds, registered investment companies in the United States are institutional investors, and they do not have to file so long as they are passive and they don't hold more than 15% of the issuer in their holdings. So it's really more that 15% cap that is protecting institutional investors from having to file. But on an aggregate basis, when you aggregate across the entire complex under these new rules, there's two things that are going to happen. One, you're more likely to exceed the 15% cap. And second, once you start aggregating between entities that are considered institutional investors and others that are not considered institutional investors, like managed accounts, then you can have a problem where you no longer have the exemption, and that would then subject your transactions to just basically back down to the 94 million threshold. And so one of the major issues with this new proposed change is that the government does want to capture more aggregate size holdings, but it's going to capture, or it's basically going to take all of the wind out of the exemptions that the asset management industry currently relies on. There is a way to handle this, by the way, which is you can make a filing months ahead of time and say that I expected this year I'm going to exceed the threshold, and if you do exceed the threshold, you have 5 years to keep on making new acquisitions up to the next threshold. So you can do this, but it's going to be very expensive. You're going to have to make many filings just on a preemptive basis, and that's just going to create a lot of burdens. What we expect to see in the industry is that some complexes may just decide not to exceed the caps on an aggregate basis, and they'll just cap their positions, and they won't go over the 15, and as a result of that, then you may see issues about impact on return on investments, impacts on capital formation, all kinds of other adverse things. And there's a process right now to speak with the FTC about these proposals, or speak with the U.S. government about these proposals, and to make sure they understand all these collateral impacts on costs and also on capital formation more broadly that the industry is working on.
Thank you, Craig. David, we thought we would use our last segment of this workshop to talk a little bit about all the regulatory developments we've seen over the past year, as we usually review of the past year, if you will, which is something we usually do during our in-person presentations in Brussels. Do you want to start and maybe talk a little bit about what happened this spring and volatility in the market, and notably money market funds?
Sure. Thank you, Julian, and thank you all for sticking around to listen to us today. We're sorry we aren't with you in Brussels as we haven't been in the past, and do look forward to being there again in 2021 if things work out as we hope they will. In any event, could we switch to the next slide, please? The one topic I'm going to cover first is some of the lessons we've learned from the market downturn, as Julian indicated, focus on the money market funds. I'll say less than I might have otherwise because Paul Stevens did such a great job during his interview really covering this issue. It's a critical one for the ICI, and he did focus on their recent report, which provides a lot of useful data to kind of help address the apparent assumption that many regulators have that somehow the money market funds really contributed significantly to the crisis as opposed to responded. Actually, we're out of sync, or less causative of the most recent crisis as compared to 2008, 2009 time period. One of the key concerns that the industry is worried about is, will this lead to enhanced regulation or additional regulation on money market funds that will make them less attractive and less attractive to investors and more difficult to manage and more expensive to manage? Especially important when we're already in a negative interest rate environment in many places. And so it's not the most compelling product for investors to invest in at the moment. And so all of the concerns that have been expressed, and we've heard concerns from the SEC chair, Chair Clayton, as well as from the Director of the Division of Investment Management, Diane Glass, that it will be necessary to revisit and to review lessons learned from the money market fund. One of the biggest lessons that people have focused on has been the potential negative impact that hadn't been anticipated, the 30% weekly liquidity threshold at which for prime money market fund boards could elect to impose fees and gates. And that became a new de facto threshold for which institutional investors that had held prime shares of prime money market funds chose to redeem as it got close to that level. They viewed it as changing the risk profile of their investment in the money market fund. So whereas in the earlier financial crisis, the concern was, we're going to break the buck. We're going to have a significant decline due to credit losses. This was purely liquidity driven, and the level of weekly liquid assets has been a trigger point that did lead to a fair amount of redemptions from the prime money market funds during the height of the crisis back in late March. The ICI's study will be helpful, hopefully, in rebutting some of those concerns, but it should mention, besides the SEC, we have heard remarks similarly from the chair of the FSB, who's also the vice chairman of the Fed, Randy Quarles, about concerns about the role of money market funds during the crisis. And next week at the G20 meeting, I think they'll be presenting their report on COVID, and anticipate that there will be effectively a need to consider additional regulation, perhaps of money market funds, to enhance their resiliency was the term that was used. What his speech did actually have a positive tone to it as well, in indicating that whatever they come up with to increase resiliency, they do want to preserve the benefits that the money market funds do provide. A counter to that positive tone, unfortunately, was reported just last week, maybe it was even this week, the president of the Federal Reserve Bank of Boston, which was the part of the Fed that ran the money market mutual fund liquidity facility this spring, indicated that they really need to look at prime money market funds, and he expressed his personal preference that there were no prime money market funds, which doesn't set a particularly positive tone there. Hopefully that's not going to be driving the debate, and it will, in any event, be something that we'll have to all focus on and pay attention to and weigh in as needed. Let me switch to the next topic, which is also fairly timely. Just a couple of weeks ago, the SEC adopted a new rule on the use of derivatives by mutual funds. It's a very significant development from the US perspective. It's been over a decade, and we're close to a decade in its birth. Effectively, there was a concept release in 2011 where the SEC had looked for suggestions about appropriate revisions. They came out with a proposal in 2015, which was widely criticized as being unnecessarily harsh and made things much worse than before. They reproposed the rule in 2019, and it was much more well received. And then in the final adoption, I think the industry's comments were also taken into consideration by the commission, and generally are more comfortable with where they ended up. Just at a very high level, the changes that have been effected were to replace a patchwork of guidance that's been in place since 1979 and was supplemented from time to time by various different no action letters, which created a not always consistent approach for different funds as to how derivatives are treated. But in concept, those guidance or those letters since 1979 have permitted derivatives not to be subject to the asset coverage limitations that are otherwise applicable to borrowings by mutual funds, for example, or other forms of debt instruments that they've taken on, so long as the fund would set aside liquid assets that were sufficient to cover the fund's exposure under the derivative instrument. That regime has worked relatively well, but has led essentially to potential risk of increased leverage overall through economic leverage, at least, even if not technical leverage, and for purposes of the Investment Company Act calculations. That system will be replaced, and the derivatives will no longer be able to rely on those relief. And instead, they will go to a path that's much more like what you see in Europe. Will be focused on value at risk calculations, and there's limitations that have been proposed to apply depending upon how much derivatives a fund uses that will come into play. One last point to mention here that ties a little bit into the discussion we'll have hopefully in a few minutes about what's the future going to hold in the next 4 years is two of the Democrat commissioners. The SEC has 5 commissioners, 3 of whom are Republicans in this administration and 2 of whom are Democrat. The 2 Democrats dissented from the proposal and essentially criticized it for having been too accommodating to the fund's concerns and creating too much risk, potential for risk in the funds. And one can imagine with a Democrat chair and a Democrat 3-2 majority at the commission that they may well seek to reform and make further changes to tighten it up. I should turn it back to you, Julian, because I think you want to talk a little bit about fund of funds and proxy voting.
Actually, there was a question that's timely. It's not directly related to the derivatives rule, but it has to do with the change of administration and direction of the SEC. I'm going to send it to you, David, because I think you probably have some views on this. What do you think the change in U.S. administration will do at the SEC? What do you think is going to be the change in leadership, and what kind of initiatives can we expect out of that change in leadership, if there is one?
I do think the areas actually we've talked about, ESG, we'll see more action by the SEC with respect to trying to be more favorably inclined to disclosure requirements on public companies, not just on investment funds, asset managers, to provide the ammunition or the necessary data to support ESG-based investing decisions that people can credibly come up with. I could see a movement by Democrat SEC more rapidly towards European approach. I don't know that they will go and truly adopt the current European approach, but it will move closer to that, and I can see that. And on derivatives, I do think they'll be tightening up. There have been a number of other initiatives within the last year that have been sort of divided with 3-2 votes. In all of those areas, you can anticipate possibility of change. One point worth mentioning is that certain regulations and the timing of some of the adoptions, which I think Drew may have alluded to earlier with the DOL's rules, have been rushed in part to try and avoid potential congressional review action. There is a statute in the US that permits regulations to be reviewed by Congress under certain circumstances and essentially overturned if within a reasonable time period after they've received notice of the new regulations, they object to it. I don't think that any of these will necessarily be likely candidates for that. Usually when you overturn it, you kind of go back to what was there before. And even the derivatives proposal, if they try to overturn that, and instead of just reforming it going forward, it would go back to the old regime, which I think most people have agreed was not the best for managing risk.
Also, at the commissioner's level, the chairman of the commission will leave at the end of the year, and will be replaced in all likelihood by a Democratic supported leaning person, and so in terms of will there be an impact? Yes, obviously there will be an impact. It was interesting to see that Biden during his campaign had mentioned a few times that he would sign executive orders requiring public companies to disclose climate change related financial risks and the like. So this is on the sort of the portfolio company disclosure side, if you will. But I think we're going to see those kind of discussions. There's an advisory committee of the SEC that is formed of non-SEC members of the private side of things, that is meeting in a few weeks, and that's expected to issue a recommendation for more public disclosures on ESG type or climate change type concepts. And so that will maybe shape a little bit what we can expect to see next year with a new administration. For asset managers, it's worth noting that a lot of the rules that were adopted in the past year, that could even be adopted before the end of the year. For example, we hear that there may be a rule related to valuation of investments in mutual funds that could be adopted in the next few days or weeks. Many of those initiatives were undertaken under the Trump administration, possibly because they thought that the topic needed to be covered before a change in government in Washington, D.C., that essentially Republican rules would be better for the industry than Democratic rules. So it may be too much of a caricature and an overstatement, but I think you get the point. So we'll see.
I would add to this too, Julian, just besides the SEC, there's FSOC, which is focused on systemically important financial institutions, and whether or not asset management industry is subject to heightened regulation to the extent that they are systemically important. That could be resurrected because FSOC's chair is the Secretary of Treasury, and they provide the guidance. And FSOC's been very limited in its action for during the Trump administration, unlike during the Obama administration, when it was organized where it was played a very active role in a lot of different scenarios. So you could see a more active FSOC having greater implications for asset management regulation in the U.S. as well.
Yeah, in the past year or two during those workshops, we told you that the SEC had proposed a reform of fund-of-fund investments, the rules that apply to mutual funds investing in other collective investment vehicles. The rules had been at a proposed stage for a few years, and a few weeks ago, the SEC adopted final rules. The rules are intended to sort of simplify this area. Whether everybody in the industry is happy about the new set of rules, I'm not sure, because it causes a number of asset managers to change what they were doing or assess how or whether they need to change what they're doing in utilizing collective investment vehicles. One thing that's worth noting here for global asset managers is that the rules put restrictions on the number of collective investment vehicles that you could put on top of each other. And they create, essentially, you can have a top fund, mutual fund that invests easily in a second mutual fund. But the moment you have the second mutual funds that invest in more collective investment vehicles, that's much more problematic. Why am I telling you this? Is that the definition of collective investment vehicle for that third tier, if you will, is extremely broad and may have an impact on certain markets. For example, CLOs and CDOs, which are used by many, many asset managers, are counted as collective investment vehicles for a purpose of that rule. And so you could have a situation where the underlying fund, if you will, and its manager are prevented from continuing to invest heavily, for example, in those type of investments.
Julian, not to interrupt, but I do want to pick up because I wouldn't want a pharma conference to go by where we don't mention the Volcker rule. That if you think about covered funds and how they were so broadly defined, it was tied into 3C1 or 3C7 in the Investment Company Act as the exemption upon which the entity relied to avoid investment company status. That's essentially the same thing that's for the collective investment vehicle. And it's that breadth of approach which doesn't always make sense when your policy is to prevent investing in actual funds, actual hedge funds or private equity funds that have greater risk. So just a useful reminder that the regulatory approach is, things never change, unfortunately. So that's the only reference to Volcker I'll make, but because fortunately we had good results on Volcker rule reform funds this year.
My pharma workshop would not be complete without mentioning the Volcker rule. Thank you, David. There was also a reform of the rules that apply to proxy voting, the type of disclosures that players in the proxy solicitation space need to make, and notably, or most notably, the new rules require more disclosure, more processes around proxy voting services and proxy voting, evaluators and consultants in their dialogue with the soliciting companies in connection, for example, with their annual meetings. And indirectly also there was an impact on asset managers because the SEC indicated that asset managers should essentially stay current with those additional disclosures and be ready to change and factor in this additional information in their process and their voting decisions, which is somewhat technical, but can have an impact on European asset managers if they manage U.S. products or have U.S. clients, or if they sell information or recommendations on votes to U.S. parties, or otherwise have an impact on U.S. issuers, something that's worth noting, although fairly technical. There was, you may recall, a mention in the past couple of years during our workshop of a moratorium that was put in place by the SEC on the registration of European asset managers and Chinese managers and others non-US managers with the SEC as investment advisors or other parties, financial services companies as broker-dealers, under the guise of conflict of law when it comes to privacy. The SEC was refusing to register, license those non-US players because they thought that their local laws, and notably in Europe, GDPR, infringed on the legal rights of the SEC to inspect the records of those parties once they were registered. The SEC was essentially saying the privacy laws in Europe under GDPR are so strong that we are not certain that we would be able to exercise or examination or enforcement authority and have access to the records that you generate and that are necessary for us to police the markets. that was a problem for a number of European asset managers who wanted to register with the SEC to do business, to get US investors. The problem seems to have been resolved or be close to being resolved with the UK. But as far as we know, the problem is not resolved with the EU. So as of today, we don't think that a European asset managers can register with the SEC yet. So just FYI, this one is not resolved. This was important for IFAMA, important enough that they had come to Washington, D.C. to meet with the SEC to discuss the matter. They had also discussed the matter with the European Commission. Well, this initiative needs to continue probably. So
this may be another area, Julian, where the change in administration could actually make it better from a kind of that issue. They could be more receptive to the workarounds that had been proposed by IOSCO and others, which weren't deemed to be acceptable to the SEC because they were too limiting. It wasn't as if anyone said the SEC shouldn't have access. It was more how quickly they had the access and the hoops they had to jump through. So you could find more receptivity to an SEC under a different administration, under Biden administration.
Yeah. Drew, is there something that you'd like to add in terms of what to expect in the pension space in the United States in the next 4 years?
Yeah, no, I think that there is on the ESG side, I think that there is going to be, the pendulum's going to swing back, and there's going to be an effort to allow managers to focus more on ESG without fear of running afoul of ERISA and without making it hard for ERISA fiduciaries to pick those investment funds. As I mentioned, I think that because the Department of Labor did soften this regulation from proposed to final, that it may not be quite as urgent. I think that just generally, and I'll close with this, that there will be a reduced amount of trust of the financial institution, of the financial institutional industry, the advisory industry. Republicans tend to believe that investment advisors, at least when you talk about political Republicans, that investment advisors are there to do the best thing that they can for their clients, whereas Democrats tend to be much more concerned about the notion of conflicted advice. So I think that they're generically, putting aside ESG, I think you're going to go from a somewhat more trusting environment politically to a somewhat less trusting environment politically.
By the way, thank you, Drew. For our audience, we're a few minutes away from being done with our remarks. So if you have questions, please ask them now. We'll be happy to take them on, but so don't hesitate. Craig, on your side, any last point that you haven't mentioned before in your space, antitrust competition, that you think will be relevant to the asset management space with a Biden administration?
Yeah, so the calls for more scrutiny in the antitrust competition space have really been bipartisan in the United States. You have the Republicans concerned about lack of antitrust enforcement just as much as the Democrats are, and so the old notion that somehow that Republicans are pro-business and would be less aggressive antitrust enforcers hasn't really been true over the last 4 years in the Trump administration. But that said, I think you will see under a Biden administration more willingness to challenge theories, to explore theories of harm and to bring challenges that are not as traditional under the antitrust law. And so common ownership, which is not a traditional theory of harm, which is a somewhat groundbreaking theory based on academia, I think is going to be taken a little bit more seriously in the Biden administration. And you can expect there to be at least attempts to determine whether there is a possibility for enforcement. Whereas right now, under the last 4 years, the administration has mostly kept the debate in the academic space and stayed out of it. I think you're going to see some pressure for the enforcers in the US to actually take a position on it. And that may require them to do the work to investigate it, which could result not only in screening more acquisitions, but also maybe even sending out subpoenas and things like that to the industry to look at documents and to collect data and stuff like that to study the issue.
Thank you,
Has there been
Greg.
enforcement in Europe, Greg, or is that?
There hasn't been enforcement. Yeah, has not been enforcement for a violation, although in Europe there has been much more discussion by the enforcers about the theory, and they seem to be giving it more support because they actually are building it into their reviews of mergers, where they talk about, not only are we concerned about these parties getting together, but also we're worried about the extent of common ownership in the sector more broadly, in addition to the consolidation between the two companies. That said, I don't think you're seeing in Europe any standalone actions based on common ownership, where it's only, where the concern is only about common ownership. It always is just sort of an add-on when there's already a problem with the merger itself.
Okay, I think, David, we're about to wrap it up. Would you like to close the discussion? If there's a topic you think we need to address, go ahead, but otherwise, feel free to conclude and hand over to Tanguy for his concluding remarks also for this conference.
I'll just make one last observation I thought about mentioning when I was talking about money market funds. And in Paul Stevens' speech, he referenced a call he had with, or a meeting he had with Paul Volcker during one of the financial crises about money market fund reform and the different views there. And it reminded me of the history of the money market funds, which essentially grew up as a market response to the high inflation and high interest rate environment of the late 1970s, early 1980s. And Paul Volcker famously was the chairman who defeated inflation in the United States through very strict controls on lots of different activity. But in that time period, when the money market funds were developing, he viewed them as a significant kind of threat to bank regulatory approach to deal with the crisis, because they were clearly alternatives to bank deposits over which they had great control. And they indeed had limits on the interest rates that could be paid by bank deposits, which is the reason money market funds came into existence, because of the greater rates they could earn in the market. And that antipathy sort of continued throughout, and it's never gone away. It's not strictly limited to Paul Volcker, but you see it from the bank regulatory side. It's the degree that money market funds are viewed as alternatives, they're outside the bank control. And so I fear we're going to see more of that coming forward, but that's it for now. So not truly responsive to your question, Julian, but thought it was a good kind of encapsulation of the last 40-some years of history, dealing with money market funds at least.
Thank you, David. Tanguy, I think the floor is yours.
Thank you very much, Julien, David, and colleagues, for the very rich presentation you just gave us on recent US regulatory developments, and also for the excellent cooperation we have had with Dechert throughout this year. This is highly appreciated. We have come to the end of this 26th Investment Management Forum. Many thanks again to the speakers, the sponsors, PwC, Gandriam, Amundi, and Arendt, and of course to you, the audience. I would also like to thank the very hard-working EFAMA staff, as well as the QED team here in Brussels. Well done to all. I hope you enjoyed the conference. To find out about our future events, I recommend you follow us on LinkedIn. Our next event will be a webinar on financial education, to be held on the 30th of November in the context of IOSCO's World Investor Week, with the participation of DG FISMA, the CONSOP, and the OECD, among others. Watch out also for our upcoming publications, including the new edition of our asset management report and a new issue of our market insights focusing on ESG investing. The next years will be extremely busy in terms of legislative and regulatory developments impacting the European investment management industry. This industry needs a strong voice. EFAMA is that voice, and I'm extremely grateful to all our members for their support and their active contribution to our work. This is it. Stay safe all. Talk to you soon, I hope, and enjoy the weekend.